I want to start with the war, Jason, and the optimism that we're seeing in today's trade. As we just heard from Tyler, a lot of the devil is in the details, but it sort of seemed like this since the end of March. Markets are looking past this conflict.
That was certainly since the end of March, and then kind of got an extra boost around Memorial Day when there was first reports that there could be a deal. It's obviously taken a few weeks to get to this point where both countries sort of acknowledge it. I think the markets and investors were already kind of ready to move past the story. The details certainly matter for the geopolitical element, but for the markets, what matters is how many ships are going through the Strait of Hormuz. Like, that's the bottom line. And if those are going to start flowing later this week and sort of normalizing, say, by the end of summer, that's what the markets care about.
Yeah, so they just want to see it open, right? And things moving around again.
Exactly.
Energy markets, though, will still take some time to get back to where they were pre-war, right? I mean, we've talked about this. We look at futures contracts when it comes to oil, and prices still have stayed elevated. It will take a while to build up reserves, get back to where we were, though. And so we'll still feel that higher energy price impact?
We'll still feel it, but you think about in terms of inflation. The impulse for inflation, in some way, the May data we got last week for CPI, that might be the peak year-over-year measure. And so if oil just stays where it is, or even goes a little bit lower, gas prices go lower, then inflation shock has a one-off level, and then it starts to sort of dissipate.
So is that why you think the Fed, the next move will be a cut? You think they're going to cut not next week?
No.
On Wednesday?
No. So we're calling for 2 cuts in 2027,
okay.
March and June.
Okay.
I want to go back to what you said about oil, because I think from what Tyler just told us, there's a chance that even after 60 days, there is no sort of back to normal with the Strait of Hormuz, or the back to normal is some sort of tolling feature. And Tyler shared with us the details that are known now. We obviously don't know what will happen in the future. Is there always going to be, from this day forward, some sort of risk premium on oil as a result of this?
I mean, there's likely to be some geopolitical risk premium. Like, how much is that going to be? All else equal, suppose this not ever happened, is it incremental $5 more? I mean, that's the markets will determine that over time. From an economic perspective, you think about their risk markets, fixed income markets. I think a key point to distinguish is that oil right now, this is a spot market, and so there could be lack of supply and demand. Mm-hmm. Equity markets are pricing on future cash flows, even bonds. And so even if it takes 60 days to sort of normalize, I think the key thing is that the upside tail risk of oil going much higher, that's been truncated. It already was, and this kind of further takes it down. It also means then the risk for inflation further rising or getting stuck, that also goes down, which also means that's why you see the market expectations for the Fed shift. That's the key thing. Maybe if it's a month, 2 months, 6 months, but if it doesn't get worse and the general path is getting gradually better, I think that's the key thing for equity markets. And the difference between ultimately for the U.S. economy, between let's say it's $70 a barrel for Brent or WTI versus 75, that's not going to be the key thing that's going to drive the equity markets. So I think that's, if it's an extra $5, not great, but that's not a game changer for the overall outlook.
What about Israel? Is it still, though, the possibility? I'm just looking at some of our stories from earlier, President Trump telling Israel to stop as Lebanon attacks risk the Iranian deal. We've just seen a lot of reporting, and just when we thought we were making some progress, Israel's certainly on its own path. And we understand everybody's got its own mission and its own goals, but is that still a risk here?
Look, it's certainly a risk, and I'm not going to, trying to put a probability on how things could escalate. When I think of, the U.S. and Iran, certainly for a while, the thought was the Iranians would be willing to kind of wait longer. They have greater incentive. The Trump administration would maybe have a more incentive to reach a deal sooner. Just from a political perspective, domestically, it's not as popular. But the fact that there is a deal, and sort of, geopolitical experts that I will talk to, they say the Iranian regime also, is under some stress. So both sides, those parts, I think, do want to reach some sort of deal. Mm-hmm. The fact that the details have not been worked out, but they're willing to publicly acknowledge it, to me says they're both trying to get there. How they deal with Israel, that's a different matter.
I think also how they deal with the nuclear material is the really challenging part of this.
Agreed.
And we're going to spend a good portion of our 3 o'clock and 4 o'clock hours talking about this, Jason. But just from your view, I mean, something that has to come essentially has to be better than the JCPOA, because that's the agreement that the president at this point walked away from. How do you get better than that?
Well, that's a political question. I think from the market's perspective, I'm not sure it has to be better or worse.
Oh, okay.
I mean, not necessarily materially. If this leads to lingering ongoing uncertainty, if the risk is that at any point in time, Iran has demonstrated they can shut down the strait, if that is something they're willing to to have in the back of their pocket, then that is certainly a kind of an ongoing, lingering risk. But unless that happens, like the markets are oftentimes priced on a base case, not the risk case, and so it's extra risk, it's extra downside risk. But the details of that, I'm not sure that specifically would matter for the markets in great detail.
So are we really safe to say and smart to say it's going to be a different Iran going forward? I mean, Iran, of course, has been, the catalyst for so many different terrorist groups, or supporter, if you will, right? I mean, do we truly think that this is now a different way forward for the region and for Iran specifically?
I think the only thing I would say with any sort of confidence is that there's a change in leadership, given what's happened over the past few months. Anytime there's any change in leadership in any country, you often see some sort of policy shifts. Now, whether this is incremental change or does it lead to some sort of more fundamental shift within Iran, that is, again, your time will tell. But the fact that, again, there's negotiations, what I hear from sort of more experts in the space is that there's a little bit more pragmatism, among the Iranian leadership, maybe less ideologically driven, but again, time will tell how this plays out.
Well, let me just throw you. There's a great story in the Bloomberg. I loved it. I kind of freaked out when I read it in this morning. Wall Street gets access to catastrophe models for the age of war. The number of countries engaged in external conflicts has nearly doubled since 2008. The economic impact of violence now stands at almost $22 trillion, and that risk experts are adapting methodologies used to predict natural catastrophes and other threats to help investors, blah, 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 blah. We know that this is a part of what any financial entity does, but it does seem like it's amped up. Do you guys talk about war and more war potentially than you ever did, maybe in the last 5-10 years? And forgive me, just about 30 seconds.
I would say, generally speaking, we're in a world that's gone from sort of unipolar, U.S.-led to multipolar, where there's geopolitical conflicts, there's conflicts and tensions regarding trade, access to resources. There'll be tension points regardless. I think that's the reality. So politics and geopolitics have to factor into how we think about it, because it's not just sort of purely economic decisions. In the 2010s, for the last 20 years, it's been central bank sort of driven markets.
Yeah.
Now I think it's much more policy driven markets.
Yeah, it does feel that way.